The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalised advice tailored to your specific situation.
And I think from my perspective, it's excellent to think about the quality of the super fund that you're working with.
True.
The quality of the research houses that these guys are working with, and the quality of the investment assets that underlie what it says on your statement.
Yeah.
I think that's a key part. And that's why that decision around should I stay or should I go has to be based on that quality. Welcome to our first pilot episode of the Wealth Guide, brought to you by Ryker Capital. Should I stay or should I go? So the topic we want to talk about today is not your relationship, but your superannuation fund. As you know, we want to bring finance concepts to you, break them down and make them simple and easy. In the past, you might have sat there and thought, should I review my super? What do I need to look at? And ended up at the thought, should I stay or should I go? So we thought we'll talk about 5 things today that you can think about to help you make that decision. The first thing that you've probably all taken a quick look at is the fees you pay in your super fund. So I might throw to our very own founder and director, Ray, to give us a little bit of an idea on what are the fees in a super fund? What should I look out for? How can I do better?
Absolutely, Jazz. I think it's a very interesting concept around fees. Fees can vary from super funds to super funds, right? And over the course of 17 years of doing this, we've seen so many different types and structures of fees that have come out.
Yes.
Sometimes you go, hang on a second, this fees does not even make sense anymore. But in saying that, look, I think it does, as I mentioned before, it does vary with a super fund to super fund. But ideally, what you want to know from your super fund is what value am I getting for the fees that I'm paying? Or am I just paying for the sake of it and there is no value added to my super fund? Another big part that sort of comes from your fees, whilst there is different types of fees, which is there are active managers, there are passive managers, there are value managers. So there's different types of fees you will pay on different form of asset class, different fund managers, right? And that will greatly vary, like I mentioned. So
when you sort of look at your statement, I know that I get 1 or 2 pages of transactions.
Yeah.
And I see money coming in and I see money coming out. And it's a dollar value. I mean, it doesn't look to be a huge amount.
Yeah.
Is that the only fee I'm paying?
No, not necessarily, Jazz. I think there could be underlying fees that could be in the form of a trustee levy or in the form of some form of a hidden asset fees that might be intertwined within the funds, which are coming out of the super fund. Now, that may not necessarily be on your statements, but usually you have to dig down a little bit into the updated PDS of that super fund to go, hey, if I was to have a look at the structure of my super fund, right, these are the fees that I'm paying.
Okay. And do you find that those fees vary as well a little bit?
Absolutely. It varies from super fund to super funds all the time. But the interesting thing is also, the good old saying about what you pay is what you get sometimes.
Okay.
And I think you've got to be sort of cautious of that. Just because you're paying lower fees doesn't equate to a return of the similar sort of amount.
Okay, so you want to make sure that the return you're getting is, I guess, the best possible return. And if you pay a little bit more for that, you might still be ahead.
Correct.
Because your return is
Correct. Because you might just go, sure, I'm paying 0.1% in fee, but doesn't equate to the returns, right? So if I missed out on 3 or 4% extra on returns, then was that paying 0.1% worth it over the course of 20 to 30 years of my working life?
I got it. So if I don't know how to find a PDS or what a PDS even is, how can I find out what my fees are?
Look, I think a great question would be just firstly speak to your super fund. I think engaging super fund at a very early stage, I think, is very, very important that you're speaking to your super fund and going, hey guys, what am I paying as far as my fees goes in my super? Can you elaborate a bit more about each of the component of some of the fees? What is the purpose of these fees? So it's very important to ask your fund or ask your advisors about what fees do they represent and what do they stand for? And do I need to pay them?
I think that's easy. You just get on the phone, have a bit of a chat with them. At least you'll feel like you know.
Yep.
I have heard a lot about industry funds, and there's a lot of talk in the media that industry funds are cheaper than all the other funds. What do you guys think of that concept, Ricky?
Yeah, that's an interesting concept. Industry funds have come in to the industry and there are a lot of them. Recently, we've also seen a lot of them merge together as well. That's a new trend that we are seeing. When it comes to fees, it's important to understand what the fees are. So it could differ from industry fund to industry fund. Just because they are an industry fund doesn't necessarily mean that all the fees are same. Some are higher, some are lower. It also depends on how the money is invested, what options chosen. So fee could be different, but there are a lot of different factors to consider as well.
So even if you have one of those industry funds that's on TV or in the newspaper saying, "Our fees are great," you guys would still deep dive. You would still have a look at that and make that a major component on the decision, should I stay or should I go?
Absolutely. Well, look, like I said, fees is a major factor. However, it's not the only factor. As we've discussed before, depending on how the money is invested, what client is looking to achieve, what are the objectives are, that would be determined on the investment style, the fee would depend on that. And it depends on where we're wanting to go.
Understood. Another thing that I've noticed over the years is, let's just say you just choose to go. So you make that decision, I'm going to leave my super fund. I'm going to go to one where I pay less fees. And let's say you save $1,000 a year in fees. What sort of a difference can that make to someone's super balance?
One of the things that we've noticed a lot of the time is when fees can make a significant difference. And when we provide advice to clients, we can actually model out what this fee difference actually looks like for a client over the long term. And sometimes just saving a little bit of extra money, whether it's $100 or $1,000 a year, that actually compounds over the next 20, 30 years whilst you're working.
Exactly.
And it makes such a significant difference to your retirement. That could mean you might be able to go on that holiday that you're planning, or could bump up your super by an additional $50,000, $100,000. So it's something that I think it's very, very important that obviously everyone looks into.
Look, that sounds really, really good. So thanks, guys, for sharing your thoughts on why it's important to check out your fees. I think the next thing that I would like to talk about in this context of deciding, should I stay or should I go? Is my super doing what I needed to do? Is around the investments within a super fund. So I might just throw back to you, Ray.
Sure.
You already spoke about passive and active before. What does that mean? And why does it matter how I invest my super?
Yeah, I think it's absolutely imperative how our money is invested. The key considerations there anytime when I sort of look at client superannuation or their strategies or their structures is, let's have a look at where your money is actually going. What are some of the asset classes that you'd want in there? I've had customers or clients who've simply gone, I don't want to be in global shares, or I don't want to be in property, or I don't want to be in unlisted assets. And again, to explain what unlisted assets is, or to unpack that is, I'll take CBS shares as an example. It's listed on the market. So if it's listed on the market, I can track it, I can trace it. Unlisted assets are assets that are not necessarily on the stock exchange. And not many people are a big fan of that or fond of that because they can't see the value of that. And if I can't attribute a value to where my money is going and how it's performing in a clear, transparent manner, then I may not want to be invested in it.
Sure, kind of like with a bank. I mean, you wouldn't go and put your money into a bank that doesn't have a presence, doesn't have an ABN, isn't listed on the exchange.
Yeah.
I think it's the same with your super. You don't want it to be in something very unknown.
Yeah. But in saying that, look, there is a place for unlisted assets, not to say that there isn't. Mm-hmm. But you just got to be careful, or I think you've just got to take a greater interest in your money to know where my money is, especially when you get, and I keep sort of harping on about this, that you only get X amount of working life. And in that working life, if you haven't sort of paid attention to how I'm invested and what my money is doing, and we've left that for a very last stage, it's not great for the growth of the fund.
I just heard Ray mention an interesting word there, risk. So in the context of asset classes, Dean, what does risk have to do with it and why does it matter?
So risk, ultimately what that means is that it's important to understand how comfortable you are with actually investing your funds, your retirement savings. Do you want to put all your money within the share market? Did you want to preserve some of it and have it in more of defensive type of assets like cash and fixed interest? And it's important, and it's very important to try and understand and have a healthy mix between having your money within the market, because obviously that's what's going to help your funds grow. But then at the same time as well, not having it too aggressive if you're at that later stages within your retirement journey.
That makes total sense to me.
And that will change, obviously, as you're in different stages of life. Someone who's in the accumulation stage, who's in the early 30s or 40s, is very important for them to grow their money. Since they can't access this super for an extended period of time, you'd want to see that money grow. If you have larger components sitting in defensive assets, that a portion of that money that's sitting in defensive assets may not grow as quicker as potentially what the share market would do that for them.
That is a very important aspect of it. So I might just throw it to you, Ricky. When you are sitting there thinking, should I stay or should I go? How do you influence the asset classes though? Because doesn't the super fund just decide that?
Well, that's interesting, because if you don't make a decision, super fund will make one for you. So it is important, as we've discussed before, how to choose the right mix of with the terms were thrown around about growth and defensive assets. So I just wanted to unpack that a little bit more. So the growth assets are the assets like shares and your property, and some of the alternative asset class like commodities and bullions and gold and silver that people invest in. So these tend to be volatile. What I mean by volatile is, as the markets go up and down, they have a greater impact on them, and hence they're called growth assets, because they tend to grow as the market grows. And if the market has a drop, you'll see a drop in the value.
So if I'm watching the news and the guy at the end of the news just before the weather talks about it being a bad market, those are my growth assets. That's what he's talking about?
Exactly right. So that's your growth assets that have share market that has gone down. So if you have a majority of your portion in your super invest in growth assets, so you will see a drop in your value. A defensive asset, on the other hand, is made up of cash, government bonds, company bonds. So that they tend to be more stable. And then what it means is, as we all know, the cash at bank, if giving you an example, if the markets drop, my cash at bank doesn't disappear. That remains the same. So your super is exactly that. So if you don't make an election going into super, what fund I want to invest into, super fund will make one for you. There are default options, and government introduced My Super, which tends to be the default cheaper option. But however, people are entitled to choose the investment option. If you contact your super fund, there will be a list of different investment options that they offer, and you can pick what you're comfortable with. We've talked about depending on what life stage they're at. So the younger we are, we can afford to take more risk because of the timeline that we have. Super is an asset that we can't touch for a long period of time, or depending where you are on that timeline. If you only just started, you can't access the super generally unless you meet a condition of release. So it allows a person to take a bit more risk than they would usually do, which means even if there's a market volatility and they lose a portion of money, they've got time to recover.
That makes sense to me. So when the guy at the end of the news says everything's going really, really well, I will benefit from that if I've got exposure to growth assets.
Yeah.
No, look, I think that is a really important part of the decision. Should I stay or should I go? Even for people that are just thinking about understanding their super better.
Yeah.
You can stay with that fund and make changes to that. That's quite powerful. So hopefully people can dig into that a little bit and find out more about that.
Wonderful.
Let's move on to the next thing that I wanted to talk about. Again, something that I think everybody puts their mind to, potentially the one thing that we would all look at when we get our super statement. I've even heard of people that have apps on their phone where they track their super balance very, very regularly, daily, hourly. I've heard all of that. Is performance. So performance is a big word. It's super important that your superannuation performs. It's super important that your superannuation does what it needs to do to help you live the retirement you really want to live. When we think about the future as financial advisors, one of the things that we come to conclusion is that the government is doing its best to support people if they're not well, if they're disabled, if they get older and they might not be able to work anymore. But we live in a world with a massive aging population. So when I meet with clients, one of the things I always stress is you should do your utmost best to be self-sufficient and be able to rely on your own money when you get to retirement. Performance plays a huge part of that. So when you guys look at a client's superannuation fund, or even when you think about your own, what do you consider when it comes to performance? And can we please also talk about the longevity of superannuation again in this context?
Yeah.
Might start with you, Dean.
Yeah, sure. So with performance, I think one of the things you would really, really want to look for is try to have some form of consistency around your returns. One of the things that we've noticed a lot of the time is that sometimes when they have their money invested within super, you might find 1 year they may have made a double-digit return. The following year, it might be a little bit less. So trying to have a real good mix and balance with those different asset classes, that's what's really going to drive those consistent returns for you within the long term, which is very fundamental.
So when the growth assets are sort of doing really, really well, we tend to see the defensive assets bubbling along and vice versa. Is that what you're saying?
Correct.
So having a mix of the both allows you to reduce and manage your risk, which is a really important component of managing and understanding performance. Ricky, what are your thoughts on investment performance in super funds? There's been a lot of talk about this in the last few years.
Absolutely. And that's what most of my clients want to look at. And this is why we invest the money for it to grow. However, performance, we've got to think performance as a long term, especially when it comes to super, because investment you might have, as Dean suggested, you might have a double-digit return on 1 year, but the market could also crash. So it is important to have that long-term perspective, because when we invest, especially super, we do it for long term, we do it for retirement. So if I'm having a bad year, doesn't necessarily mean the super fund's bad or the investment's bad or my investment strategy that's been put behind is wrong. I think this is where we see a lot of clients in a year where market drops, where people panic and they try and sell out of their funds and they try and change investments. So performance is a long-term game, and I think people should definitely consider and have faith in their fund, in the investment and the strategy that's been put through to ensure that, yes, there will be volatility. That's the part of the game, and to have that long-term view.
Just to add to that as well, Ricky, I think when the market's bad, it doesn't necessarily, and I've seen this happen so many times where clients will just pull out. And the scary thing about that is that when market's taken such a big dip, and by us selling out, we've just locked in that low price. What we could see, even if we go back through our most recent experience around coronavirus and everything that had happened, I'm never going to forget this day. But I think it was the 23rd of March from memory. We obviously got into lockdown and things like that. And the market was sitting roughly at around about 6,800 points. And then by the time the lockdowns came in, then the market literally bottomed out by around about 2,000. But cutting a long story short is that it only took the market a few months to actually recover where it actually was before the downturn.
Yeah.
And then not only that, it actually went a lot higher than what it actually was before the downturn.
Exactly.
So it's important just stay the reins and just keep pushing. And there's always going to be volatility, but as long as you've got some good strategies and structure behind you, then you obviously be always okay within the long run.
And again, to that point as well, I think it's important that you're working with your super fund or working with your advisor primarily to make sure that some of these asset classes that you invested in, and you're doing these regular visits with your advisor to make sure that these asset classes are still what you want to be in, and they are actually the right structure that you want to be invested in, and having that constant conversation with your advisor and your super fund is imperative, that you're constantly retouching on those investment options. Just because you're staying in a option does not mean that it will always be performing at all times. And
more on that, Jad, I would like to also add to it, it's a drop in value. In our super funds, we hold units. So like, for example, shares, we hold if people own shares, they own number of shares. So it's the value of that shares or value of that investment that's gone up and down. So they haven't necessarily made an actual loss. The value has gone down. The value could come back up again. However, people, going back to the previous points, is when they sell out of it, hence they've actually incurred a loss, because they've sold those units.
Look, we've talked about this quite a bit now throughout this conversation. So as a person listening to this podcast, can you guys share a little bit about why do you have this belief in the investments? It's easy for us to sit here and say, don't worry.
Yeah.
You've got this unit price, you've got this share price, the market will come back up. Can you guys give us a snippet of, from your experience and from your studies and your education, why is this the case?
Again, going back to the historical figures as to whenever you look at the data of the historical figures of the market and the economy as they're progressively grown, the market has grown, which creates a good inflation-proof investment structure whereby you're keeping your money up to date with inflation. So market has always grown throughout the course of the history, and it has. Yes, you have your cyclical ups and downs within the market, which would trigger it, but doesn't necessarily mean, again, that it will always be in a downturn mode.
And I think from my perspective, it's excellent to think about the quality of the super fund that you're working with.
True.
The quality of the research houses that these guys are working with, and the quality of the investment assets that underlie what it says on your statement.
Yeah.
I think that's a key part. And that's why that decision around should I stay or should I go has to be based on that quality. So if you think about investing into, for example, something like a CBA, as opposed to investing into a startup online bank, there is a huge difference there. Yeah. Now, you may want to take a small position in the startup online bank. Just think Afterpay.
Yeah.
But you probably would not want to expose your entire balance sheet to that. You'd want to have a good amount of Commonwealth Bank. We don't always have the time to make those decisions day to day. So that's another part of us relying on our super fund. And that should make up part of the decision. Should I stay or should I go? What's the quality of the investments, the investment managers? What's the philosophy of the fund?
Again, I'd go back to the same point. I think it's key critical that you are working with your advisor and your super funds to ensure that some of these asset classes that you're in over the long term are going to serve the purpose that super stands for.
Amazing. So to date, we've covered 3 points, or 3 hot tips, as I like to call them, that most of our listeners and viewers would have probably thought about before. I want to now turn to what I call the fund's structure.
Right.
Now, this is a little bit more of a topic where the financial advisors get really excited, because we obviously totally deep dive into superannuation funds. We love detail, we love numbers, we love comparisons. So one of the points where we can really make a huge difference to the way that your superannuation fund serves us is by looking at the fund's structure. Does the fund have a really good, solid structure? Is the fund of good quality? There are then also things that we need from our fund. We need it to do certain things and allow us to achieve certain goals. So I'd like to talk a little bit more about this first. Before we start going into the detail of that though, how many times have you sat with a client and you told them about some of these fund structure concepts and people just really didn't know anything about that, right? Have you got an example of a client that you've shared something like that with?
Absolutely.
Made a really big difference to their life?
Absolutely, Jazz. I think the structure of the funds are, again, important, and they will be very personal to each client and will differ from client to client. So one of the big impacts that one of my clients had, having a Brady Bunch family whereby they had kids from the first relationship and the second relationship, for them, something like a binding nomination structure is very important. Now, not many people understand or know what a binding or non-binding stands for. So non-binding simply means where a trustee can make decision on your behalf whether that person is entitled to your benefits upon your death. However, a binding nomination takes that decision away from the trustee, and as you've stipulated, going, if I want my money to go to my kids or my wife or my ex-spouse, binding death nomination will allow to do so. So that's the key important part that had really helped one of my clients.
I can imagine that would make a huge difference to them.
Yeah, because they didn't want the money to go to a person that they didn't want it to go.
It's a very interesting part of the superannuation structures because superannuation is held in trust. So we don't actually control it ourselves. No. And that's probably something that everyone is aware of because of how far removed it sometimes seems from your other assets on your balance sheet. So a trustee is in charge of protecting our money, making
Correct.
it grow. The sole purpose of the trustee and the sole point of what they're meant to do is to look after our money well. When it comes to things like binding death nominations, one other interesting part of this is that it's a non-estate asset. Dean, do you want to tell me what that means in simple language?
Yes, so basically what a non-estate asset is it's an asset that doesn't stipulate part of the will. So it's important to make sure that once anything was to happen to you, God forbid, you make sure that your death nominations and everything within the super fund are all structured correctly. So in the event of something was to actually happen, then at least your funds are going to be distributed according to your wishes.
And why is that the case? I mean, estate law, it's pretty serious stuff. How does the superannuation environment manage to get around that?
It allows you to, because it sits outside the will, you don't. The estate doesn't need to go through probate and all of the things that they need to do. So if the super fund has a binding nomination in place, the client can ensure the money can go to the beneficiary that they want directly through them, bypassing all the state laws. Which is a great thing about super. And we've had many case laws proving that where people have challenged binding nominations made, which has been unsuccessful, where because of the rule that states trustee is bound by the decision made by the client, and hence they have paid that.
Now, which wouldn't be the case in a case of a non-binding death nomination. It's very well contested and the trustee will then have to allow for other people to partake in that money.
Look, I think that one of the cases that springs to mind here was where a family had large assets that were held up in a farm. So it was a regional farm and it was large, huge, and it was worth a good amount of money. But between the two siblings, only one of them would ever be able to sort of take on the farm. The other one wouldn't have been able to manage that. So what the parents did in that case is they actually used superannuation as a vehicle to ensure that the cash assets that they had were able to be popped into the superannuation environment and then directly passed on to the sibling that wasn't going to inherit the farm. But the other sibling then was able to basically look after the farm, take that over. And as we all know, it's a tough time for people when it comes to the end of life. Especially when there are things like farms, animals, children, other people attached. So taking away some of those concerns can really help a family throughout that time. Also having those conversations much earlier than when the actual tough times come and being in control of making these kinds of decisions is super powerful. So that decision, should I stay or should I go, is really important and it can stretch out to a really, really long time in the future. So binding death nominations is one part of a superannuation fund structure. What are some of the other things that are important when it comes to super? I'm just thinking about, getting a hold of them, maybe looking at statements. I mean, sometimes you look at statements, we see a lot of them. You go, what are you trying to tell me? So, Dean, what do you think? When you get a super fund, when you make a decision, what do I want from my super fund? What are some of the other sort of structural aspects?
Definitely communication side of things as well. I think I've tried multiple times, even with clients with me, just trying to get a hold of the super funds can be challenging sometimes. I can recall there was one time I was actually waiting online for 45 minutes. And then the funny thing is by the time I got to speak to someone, they then wanted to transfer me to someone else because apparently I got to the wrong department. So just something that's actually simple to use. And I'll also say as well, even when it comes to wanting to do little things like withdrawals or making some changes to beneficiaries, how quick do they actually do these types of things? Are there a series of forms do you need to fill out? Can it be something as quick and convenient or going online and doing it? Because once again, the more challenge that it becomes to do, then naturally you're not going to be really wanting to do it, which can then obviously have an impact in the long term as well. So
it can be challenging, can it? Like the accessibility of information from super fund, and it's very hard, especially if you don't know what you're doing. That education part and you know what my super fund's doing for me is just absolutely an important attribute in choosing whether to stay or to go with the super fund, right? So I think that accessibility piece plays a vital part. No one's got time to sort of sit there for an hour and a half just to wait for super fund to answer their phone.
One other thing we are noticing, well, I do tend to see a lot with my clients is sustainable funds now. So that's really with the impact that we are having, the global warming and the things that we are listening on the news a lot, people are now choosing for their fund to do the right thing. So sustainability, investing in a way that's environmentally friendly, or not investing in industry that create more pollution. So that's a new trend. So probably a good idea if that is something that you want to do, to check with your super fund if they offer sustainable investment options, because some of them don't.
I did not know that you can have that much of an impact on where you invest your super. That makes me think about other things. What if I'm a little bit more astute and I've actually got some very strong thoughts on what I want to buy? Maybe I want to skip the whole property thing, or maybe I want to make some decisions on direct shares. Is that possible?
Absolutely, Jazz. I think there are some superannuation providers, which is what we call them wraps. Now, what wraps stand for is pretty much a baseline platform whereby you have access to all these variety of different direct shares or investment options, which otherwise you wouldn't have had access to. Simply put, I can if I wanted to invest purely in CBA shares, I'm allowed to do so because I've got accessibility of this wrap. But again, key important decision then is made from that point is get your advisor involved to make sure that you are also appropriately, or you have good diversification mix of asset classes in your super, not just I just want to be in a part of an asset.
And we also look at it, when we look at a client portfolio, we also look in a holistic way. If client already has a good amount of investment property portfolio built up, we may even consider reducing the allocation in order to ensure that client's overall portfolio is not just skewed towards property.
Yeah. And it purely comes down to the earlier point about performance.
Yes.
What we want our clients to do is have a good round of performance throughout the course of their working life and even after that.
Yeah.
So for us to have that key diversification is key critical.
One of the last aspects I want to touch on when it comes to the structure of my super, should I stay or should I go and open an SMSF, a self-managed super fund? That is really the same thing. It's just the different structure. What's your guys' thoughts on that? If you are looking at maybe going down that road, what are some of the differences between having your own self-managed super fund or SMSF and having a fund that someone else looks after for you?
It's an interesting concept with the self-managed super fund, and it's a very growing industry with self-managed super fund. There's been a lot of my clients who are wanting to make sure that they have properties inside the self-managed super funds. I think anytime I've done that exercise with my customers, I've sort of always asked them about doing your cost backwards. Mm-hmm. What is it going to cost you to create, run, retain that self-managed super fund?
What do you mean you have to run it?
Absolutely.
It's called self-managed.
That sounds scary.
It's called self-managed, Jazz. What you're basically doing is put on a trustee cap going, I am now the trustee of the super fund.
Okay.
I know all about compliance. Yes, I'm going to have people like my accountant, my advisor, who will help me run the self-managed super fund, but ultimately you are responsible for it.
And that does sound like there are some expenses.
There are some expenses in there, which could include accounting fees, auditing, financial planning, insurances, and variety of other legal costs that would be required to run the self-managed super fund. So if you are going to go down that track, I highly recommend that. I think you have a good chat with your advisor or an accountant prior to engaging in that part of the strategy. But key consideration is any form of assets that you're looking to buy in that self-managed super fund, you have to do your cost backwards. What is it going to cost me to run? What is my income? What is my expenses?
Well, and you've just told me that I can pretty much buy most of the assets in one of those wraps.
Correct.
So, Dean, do you have
property.
an example maybe of some of the assets that you see clients buy in self-managed super funds that make a lot of sense?
clients potentially can utilize, and I see sometimes if they go down that avenue of buying property, I'm a big believer that you don't want to always put all your eggs within the one basket. I think having something there alongside of it to complement it, whether it's a parcel of shares, a managed fund that's obviously has pretty much a pool of different shares, and using that alongside your other investments just to make sure you've got that diversification is very important. Or maybe you just want to purchase direct shares. Or maybe you might have a business and you're looking at potentially buying the commercial property that you're currently operating in. And then you can structure that through the self-managed super fund and do things like that. So the self-managed super fund, there's a lot of things you can do with it. But at the same time as well, it comes down to what are you really trying to achieve? What's the purpose? If you can't achieve that with where you currently are at the moment, then maybe having a look at something else like a self-managed super fund.
And in closing to that, Ricky, I was just going to throw to you maybe to let us know a bit of a guide. So how much money should I have before I would consider moving out of a managed structure into something like a self-managed super fund?
Well, that's an interesting question, Jazz. There isn't, it's like how long is a piece of string, so it can't put a specific dollar value. I remember ASIC, the government body, used to have a figure of about 500. I think they've put it down to about 250 now. However, it really, as Ray and Dean have alluded to, it really comes down to what the client's objectives are. What are you trying to achieve? I have seen clients with their self-managed super fund, and they've opened it, they've pulled all the money into their super, and all it's doing is sitting in a bank account.
Wow.
And it just sits in a cash account and it's there. It's not doing anything. They're paying all the fees that we've talked about. And so it is quite critical if you are thinking about self-managed super fund, you understand that you will be taking on a lot of roles. Yes, it is attractive to a lot of people because the clients I get is mainly about being able to buy a property. And especially in our Australian market, people are being forced out of the market. So this super does create that extra avenue for people to buy property. However, even if you're thinking about opening a self-managed super fund and buying a property, there are rules around it. You cannot live in that property. So it is very important that people think of it as a long-term. Super is for long-term. It is there to fund their retirement, not necessarily their immediate goals. So a self-managed super fund can work, but people need to be very clear on the strategy.
Amazing. Well, let's change tack a little bit. There's one last topic I want to talk about. It's a big one. I know you guys are going to have a lot of tips. But let's take our minds back to sort of just having a normal super fund now. So I've got my statement. I've had a look at my fees. Okay. I know that I've got different asset classes. I've got a mix, right? And I've checked out the performance. I've had a look at 1 year, 3 year, 5 year and 10 year returns. I haven't just looked at last year. One big thing that's on probably most of our super statements is comments and notes and more fees about insurance. So, Ray, talk to us a little bit more about insurance in super.
Yeah, absolutely, Jazz. I think, look, it's interesting what sort of we found within the super funds for some of our customers was that they started out with this value of 250,000 as the base value. Mm-hmm. And over the period of times, it would just go from 250 to 190. 190,000 now down to 150, 140. Mm-hmm. And we were all left scratching our heads going, why would I pay you to pay me less? Now, it may work in cases for some of the customers where they don't have that particular type of need. But if it's a family where I've got 3 kids, that doesn't work for me. Why would I want to get paid less money in the event of a claim? So it's important that you review not only the structures inside your insurances inside your super, but before you decide, should I stay, should I go, make sure you don't cancel your policies. Because wherever you were to move your super funds into, you might want to consider taking out a policy where you go through the full underwriting process. And during that process, should something was to come out of that medicals, an insurance company was to go, sorry, we can't offer you cover due to a variety of health reasons, at least you've got a policy. So again, it's imperative that you go back to your advisor and speak to your advisor before you make those important changes within your insurances.
Okay, so we've established now, Ricky, that insurance companies are pretty clever. As we grow older, they simply reduce the payout amount they have to give us if the events happened. I know that you're very passionate about this topic. Whenever we go to speaking events, you also reveal another aspect to that. Not only does the amount of cover go down, what else do the insurance companies do?
So that is interesting. I'd like to start by taking one step back. With superannuation, it is great. The primary purpose of super is to provide for retirement. However, the ancillary benefit that government has allowed is to clients to hold insurance. So it is, I do want to start by saying that it is great that we can have insurance, but it is a good benefit that can be added on to that retirement benefit that we are doing. So having any amount of cover is great. However, we need to look at what we are really paying for. So going back to your question, the default cover in your super could possibly go down with age. As we get older, the cover could go down. However, the premiums may be going up as you get older.
That does not sound fair at all. I get less of a payout and I have to pay more for it.
Yeah. It is, unfortunately, that's how it's been designed. But clients do have options and choice to have their own insurance, which they can get and get paid via super. So
how can you do that?
There are insurance companies that allow you to do that. And in order to get that, you can't get it directly. You have to go through an advisor, speak to an advisor about it, especially because you are using super to pay for your insurance. It's really important that we also consider that we don't erode client super balance.
Correct.
Because if we are paying premiums, we also have to factor in the fact that the money is going out of their retirement capital. So we have to ensure that we balance that. We find the right balance of the right amount of cover, the right amount of premium that clients are comfortable with. And we can mitigate that by putting a variety of different strategies around it to ensure that they still get the growth and they're still covered.
But I think that's a key consideration, what Ricky said. I think it's paramount that you mix the match of the both worlds over there to make sure you have the right type of cover, you have the right definitions to further go into that part. You also make sure that some of the definitions in these policies, you have to ensure that you're reading the definitions to go, what condition would construct into a payout? So when you look at the TPD definitions, when you look at the income protection definitions, there are over 30, 40, 50 definitions that you ensure that the policies are structured in a way that is in the favour of a client. And you also got to ensure that you're not, like to Ricky's point, eroding super fund balances, because that will have a massive impact on how I'll choose to live my retirement. So there's got to be this perfect match around how it should be structured and how you can construct some of the tax effective strategies, because there are some great strategies that you can create to have this insurance and create them as a tax deduction at the same time.
I really want to get back to that point we made earlier around having maybe a family to look after or thinking about the needs you have to even have insurance. So Dean, we all know you can have insurance in your super, but do you think all your clients know how much insurance they should have? What are some of the things that we should think about when we're sitting at the dinner table, maybe a piece of paper in front of us thinking, should I stay? Should I go? Is my insurance in my super really helping me? It might even be a couple sitting together. When you facilitate these conversations, what are the things people think about?
I think the most important part is that given what would you want things and life to look like if something was to actually happen to you? Yeah. Do you want to make sure that at least the debt's paid off? If you've got a family and young kids, got to make sure providing a little bit of a lump sum there for the kids to get them through their education and their schooling. And then also as well, most importantly, if you've got a dual income, and I've seen this happen so many times where you've got a dual income and both partners are working, but then when we look into their budget, they're not saving really much money. A lot of their income is going to their living expenses. Now, if one of those partners or anything happened to either one of them and they could no longer continue to work, then naturally speaking, then their families is going to be in some form of financial stress. So making sure that obviously something can be put in place to make sure that they don't have that burden, they don't have that stress. At least they can focus and worry about getting better and back to their health, opposed to, okay, well, what are we going to do with the mortgage this month?
You're right, because if you think about having a stress of looking after someone, adding on financial stress onto that, it can be huge. It can take a huge mental toll on you. Here you are looking after your husband or wife, which is quite a stressful situation in itself. Now, having that added pressure of going, bank is knocking on the door going, I need to make mortgage repayments. My God, that's stressful.
I think one of the main things that I also think about in this context, Ricky, is I've applied for insurance. I've got insurance myself. I've gone through that process. But I think a lot of Australians haven't. What are some of the differences between that default cover that I see on my super statement or then what I would call underwritten cover? Can you outline those differences for me? And can you maybe also tell me what it means to underwrite cover in a bit of detail?
There are different insurance options available. So to start with, there is a default option most of us have in our super. They are, as I suggested, the default option. They're given it to people without any consideration about their health or where they are and how they're paying. And the premiums are decided on a group as a whole. So if I'm part of Super Fund A and there are thousands of members in there, everyone gets that cover. So the premium is decided on based on that amount of cover and the premium. If my health is good, I'm still paying for someone whose health is not as good. So hence the premium sort of varies and it's all just one bundle of insurance.
Are you saying I might be able to get a premium that's better because I'm in good health?
Exactly. So this is where the underwritten cover comes in, where clients can look at having the cover personalised to themselves based on their age, their occupation, their health. A underwritten cover is where the insurance company would factor all those situations. They would understand how old the client is, what occupation they're in. So if people are in an office role, white collar job, they tend to have lower premiums compared to a blue collar role because there are more chances of people hurting themselves or injuring themselves, or more chance of making claim. So if you are in a blue collar role, I would stress that you should have insurance because there are more chances of you potentially hurting or injuring yourself and having to make a claim. So an underwritten cover is where the insurance company goes into an absolute detail. They understand your health, they understand your financial position before they offer any cover or before even you pay a single dollar in premium. Whereas in a group cover where you are bundled as a part of a entire super population and you are given cover based on that may or may not suit you. Another cover where people can actually ring up a variety of different companies and get cover. Even there, I would caution people if they have been underwritten. I've had a number of cases where clients have got cover and they've told me, oh, Ricky, I've got $1 million worth of cover. And when we looked at the policy schedule, their occupation rating was completely different to what they are doing. So in that case, it could be, at the time of payout, could be a big issue.
This looks like one of these scenarios where you tick a box saying you've read all the fine print.
Yeah.
And then at the time you want to try to make the claim with the insurance companies on the TV, who shall remain nameless. Is that the time when they then start asking you questions?
Exactly. They start underwriting you at the time of claim. Well, don't get me wrong. All insurance company, if you are making claim, will do their due diligence. If they have to pay someone $1 million, they would want to make sure the claim is legit. So they will ask questions. However, the chance of a claim of an underwritten cover would be more likely to go through because insurance company had known everything about you before you took on the cover. And it's also good for people at a younger age to have that cover, which means when you are fit and healthy, your premiums tend to be a lot lower. And you can also, there are different ways of where we can sort of fix the premiums in a way that they don't become unaffordable down the track. Because if people trying to get cover at a later stage, sometimes they may not even get cover.
It seems to me, Ray, like there's two main reasons of why I should put myself through dealing with an insurance company in what seems to be an extensive way. None of us like to fill out forms and do a lot of work with insurance companies. But it seems to be around, I need to make sure I'm paying the right premium. And then the second thing that's really coming through for me here is if I have decided that I need this cover, I need it to be paid to me at the time of claim. I'm pointing to you because I know you're very passionate about cases where claims are not paid out, especially when those claims are inside super through those group covers. And you and I know that we would have been able to get that claim paid if we had have underwritten. So tell me an example or a few examples of why should I put myself through underwriting to get out to a policy that I can really understand and that I know. What are some of the specific things that are different in group style covers and not underwritten covers?
Certainly. First thing first, insurance companies are here to pay genuine claims. I just want to take that myth away. Insurance companies are here to do the right things and they want to pay the genuine claims. Now, in some of the cases where the claims haven't been paid out, or why should you take an underwritten cover? I think it's pretty simple. If I'm going to pay money for an insurance company, I want to be underwritten. And the reason I want to be underwritten is you can know about my health, ask me the questions, you're paying for my medicals, hey, go for it. And then once you've got all that information, then I'm paying for a cover that is personalised to me. That is personalised to me in a sense that I want to be covered for those specific events that I'd like to be covered for, whether it be my family history, whether it be a certain thing that I feel that may happen, or want to provide for my kids. So if I'm going to pay money to an insurance company from my super fund, I might as well go through the underwriting. At least I have this peace of mind that I'm not going to have to jump through these hoops and hurdles of underwriting at that point in time and claim.
In the future. Look, I think one aspect for me, just I've got 2 kids as well, going through a period of time where I wasn't working, where I was on maternity leave. One of the main things that I'd like to highlight as a specific example you need to look out for is that, you know, when you go through underwriting and you have an advisor and you really talk about yourself, you start to understand when will that policy pay me and when will it not. When you just have insurance that's sort of a quick one through the TV or when it's in your super, unfortunately, we don't really deep dive into the details of the policy that might work against us. One major thing, for instance, that is an inhibitor of a claim being paid out through a lot of the group covers inside super is if you haven't been working for a period of time.
Correct.
And when you are in that stage of your life where you got married, you're having kids and might be your first pregnancy, let me tell you, the last thing you sit there and think about is, will my superannuation income protection insurance pay me? So these are the kinds of things that I want our listeners to understand. If you are having a specific circumstance that occurs for yourself, make sure that your cover suits your needs.
Absolutely.
A lot of these policies have clauses that say if you haven't been actually going to work and participating in your job for at least, say, 6 out of the last 12 months, then you will not be entitled to be paid out. Don't get me wrong, you're still paying your premiums. The cover's still there, but it's these details that sometimes will trip people up.
Yeah.
Have you ever seen a circumstance maybe dealing with an occupation or, you know, someone not being covered on heights or something like that?
Yes, I actually had a client recently. Well, actually, no, this one was a while ago. I actually had a client. They had a generic policy through one of those insurance companies over the phone. And funny story with him, he from memory, I think he was a plumber, and he broke his leg at a job site, and he had to be off work for around about 4 or 5 months.
Yeah.
Because he broke his leg. The scary thing is he then came to me to wanting to review his cover after the incident. But cutting a long story short, he went to make a claim and the insurer didn't want to pay him. And in any normal traditional type of income protection policy, if you're sick, ill, injured, and you could no longer, or you can't work and do your day-to-day duties, then by all means, that actually stipulates a claim. That shouldn't be an issue to make a claim. But this other insurer, they didn't want to pay anything.
Another scenario that comes to mind is in the very unfortunate circumstance that you're unable to ever work again. Think about this, guys. Most people think their home is their biggest asset.
Yeah.
If you are an astute investor and you have a portfolio, you might think that's your biggest asset. But it's actually your ability to go to work and earn an income that is your biggest asset. If you do the numbers and you sit there and work out, if I earn my income and that goes up a little bit with inflation for the next 30, 40 years, that'll be millions of dollars. So from my perspective, I would want to protect that asset, like I have car insurance or home insurance. So if I'm sitting there thinking, look, if that unfortunate event were to happen and I can never go back to work, what sort of cover can my super fund give me? And I'm thinking about a specific restriction, which is the period the benefit gets paid. Because I know that inside the super funds, there's quite a heavy restriction on that.
Correct.
Someone want to comment?
Yeah, I think, isn't that funny though? I think I love your comment about that, Jazz, because we cover our cars, we cover our homes, but we don't cover the income that pays for all of it. Right. So I think if I was to sort of start a structure whereby I go, what should I be covering first? My income would be on the very top list to go, I better cover this income that pays for everything else. So the benefit period usually varies from fund to fund. Some will cover you for 2 years. Some will cover you for 5.
Hang on. That's not enough.
No.
I'm going to be working for another 30 years.
Exactly. So it also depends on your age group as to what age you're going to make that claim. So I think it's important to sort of then understand, putting yourself in that position to go, what age where I'm at and how long do I want to be paid for? I think important consideration there is, how long is my mortgage contract for? So if I've got to pay that mortgage contract for another next 25, 30 years, it's imperative that I've got that age 65 benefit rather than just paying for 2 or 5 years because, hey, my mortgage payment's not going to finish until another 25, 30 years.
Yeah.
So it's important to consider the fact that your income protection policy is paying you to age 65. It has the right definitions in there.
Yeah.
That's not going to prevent you from making a claim on those policies. Another big factor would be that it's increasing value with indexation. That not only covers your mortgage, but also allows you to put food on the table, send your kids to school.
So you're thinking about what we're all going through right now. In Australia, things have become a lot more expensive in the last 3 years.
Absolutely.
So if my cover is still sitting there at that amount that I started it off with,
Yeah.
how am I going to meet those increased expenses?
Absolutely not. You wouldn't be able to. Yeah.
So that's why I've got to have something called indexation on my insurance.
Yeah.
Okay.
Key part.
One other thing, Jad, I also think about is super. If you hold policies inside super, not only do you need to satisfy the insurance rules, but you also need to satisfy superannuation rules. Because as we all know, we can't touch our super. I can't go to my super fund now and say, give me my money. They won't give it to me because there are rules around it. Like we discussed, it is for retirement, so it is then preserved for retirement. So in an event there is a payout, once, even though you might have satisfied insurance rules, then we also need to look at satisfying superannuation rules in order to make sure that we can actually, the money doesn't sit in super account. It actually does go out to the client because it may not happen. So we need to be considering those factors as well, having cover inside super.
Yeah. In closing, Dean, can you just give me the 3 things I should do when I'm sitting at my dinner table with my partner and I'm thinking, should I go or should I stay in the context of insurance?
Yeah, sure. So most importantly, look at the definitions to make sure that in the event, if anything was to happen to you, to make sure that the claim will actually be successful, because there's no point of paying for premiums and for a policy that you're not going to be able to claim on. And I'll also say definitely as well, making sure and understanding, do you have the right level of cover? If you have a mortgage of 7, 8, 900,000 and you've only got cover for 200,000, then there's a bit of a problem there. And then also as well, as we were saying previously, around the premium side of things, how much are you actually paying? Is your level of cover reducing as you go on? Which is something that's very important to look into as well.
I better sleep with my one eye open tonight, especially my wife knows how much I'm insured for.
You better be careful.
Fabulous. Thanks so much, guys. I think we've had a super fantastic discussion about superannuation. We've talked a lot about should I stay or should I go? So in summary, think about what are the fees I'm paying? How am I actually invested and does that suit me? Is it going to allow me to meet my goals? Is my superannuation fund performing? And don't just look at the 1 year, really dig a little bit deeper to see if it's meeting your long-term needs. Has it given me what I need from it? Am I getting information I can understand? Can I read my statements? Am I in the right structure? If I'm passionate about the environment, or ethical investing, or maybe want to buy some shares. Can I do what I need to do with the structure that I've got my super fund in? And last but not least, you've got an awesome opportunity to actually protect yourself along the way to retirement, so that if an unforeseen circumstance happen that's going to throw your retirement plans out, government's allowing us to use superannuation to protect ourselves and our families against that. But am I going to be paid out? Am I overpaying on my insurance? Can I get the policy paid to me, and can it come into my bank account so I can use it? Those are all the most important things in our view that you should think about when it comes to should I go or should I stay? Superannuation episode. Thank you so much.
Thank you.